Donald Trump has just pulled off a stunning comeback.
Thank you very much. Wow.
Supporters are celebrating the return of American first policies, while skeptics brace for another wave of unpredictable decisions that could ripple across global markets.
Fake news.
In today's video, we're going deep into the likely impact of Trump's presidency on the US and global stock markets, specifically in the short, medium, and long term. At the end, we'll also discuss the best way to approach the stock market in these volatile yet potentially highly rewarding times. By looking back at his previous term and the recent policy proposals, we've tried to get a clearer picture of the potential opportunities and risks on the horizon. Part 1, the immediate shock. Short-term impact on the markets. So, let's start with the short-term outlook. Historically, Trump's election resulted in a unique market phenomenon, with his influence driving rapid spikes and dips. Back in 2016, his victory initially spooked the markets.
He will make America great again.
With the Dow Jones futures plunging 800 points overnight. However, within days, a wave of optimism swept across Wall Street.
Tax cuts for American families.
Investors quickly adjusted to the promise of pro-business policies, with sectors like energy, banking, and defense stocks soaring. The Trump bump, as it was called, saw the S&P 500 raise nearly 6% in his first month in office. Now, on the heels of his 2024 comeback victory, we are seeing a similar phenomenon. The day after the election, the Dow surged 3.5%, the S&P 500 climbed 2.53%, and the Nasdaq rose 2.95%, each index closing at record highs. This rapid rise reflects investor enthusiasm for Trump's business-friendly promises like tax cuts and deregulation, which many expect to boost corporate profits. Additionally, the rally was powered by Trump's trades, investments that benefit from Trump's policies such as energy and defense stocks. But the market rally didn't just stop at stock. The yield on the 10-year US Treasury note jumped to 4.479%, a 4-month high, as investors priced in the inflation risks that could arise from Trump's proposed fiscal policies. High yields indicate that investors are expecting stronger economic growth, but they also signal potential inflationary pressures. Bitcoin equally reached a record-breaking high as investors sought to hedge against inflation and dollar fluctuations. In addition to Trump's supposedly pro-stance on crypto, making all those crypto bros happy, one thing we should expect is short-term volatility in global markets. Trump's America-first approach in his prior term led to strained international relationships, and there's little reason to expect different this time around. In his first term, Trump imposed tariffs on over $300 billion worth of Chinese goods, sparking a trade war that sent global markets into chaos. Between 2018 and 2019, the MSCI World Index, which tracks stock markets worldwide, saw an increased volatility with multiple correlations directly related to the US and China tensions. If he does resume this hard stance against China, we might see heightened volatility once again. We have seen some large banks such as HSBC restructuring to be able to continue operations should a West and East divide occur. Emerging markets, particularly those heavily dependent on exports to the US, could face a rocky start under Trump's leadership. For instance, in 2018, the Chinese stock market lost over 25% of its value due to Trump's tariffs, and the Mexican peso tumbled as trade renegotiations loomed. We might see a repeat of these reactions, with markets in Asia and Latin America showing increased vulnerability to the sudden US policy shifts. We've already seen that those markets are quite weak right now, so it could be an interesting time. Part 2, the midterm effects. The next few years of Trump's presidency. After the initial reaction, markets will likely start adapting to Trump's policies. In his first term, Trump's economic focus revolved around tax cuts, trade renegotiations, and regulatory rollbacks, which spurred US growth. The Tax Cuts and Jobs Act of 2017 was one of his signature moves, which reduced corporation tax from 35% to 21%, boosting corporate profits and contributing to a nearly 30% rise in the S&P 500 from 2017 to 2019. If Trump pursues further tax cuts, corporations could see higher profitability, potentially lifting stock prices up. But there is a catch. With the US debt already at record highs, over $33 trillion as of 2024, more tax cuts could further balloon the deficit, which could lead to long-term economic instability. I've been on various calls with experts this week, both in the political and economic space, and they are predicting that we could see tax cuts significantly quicker this time around. The midterm could also witness intensified scrutiny on multinational corporations. In his previous administration, Trump encouraged companies to bring manufacturing back to the US soil. Companies like Apple and Ford pledged to invest in domestic operations, though with mixed follow-through. Now, Trump might push his agenda even harder this time, potentially leading to penalties on companies that offshore production. Such measures could disrupt supply chains, impacting both tech and consumer good companies that rely on global suppliers. One area where we could see significant medium-term impact is international trade. Might we face a trade war round 2? Trump's trade policies were among the most controversial aspects of his first term. For instance, his tariffs on China led to tariffs being imposed in retaliation from them. This hit American agricultural hard, with soybean exports to China dropping by over 50% in 2018. If Trump resumes these trade tactics, it could spell trouble for American farmers and manufacturers who rely on stable international relationships to thrive. Beyond China, Trump has been critical of other trade alliances such as NAFTA, which he replaced with the USMCA. While the deal did bring some benefits to the auto industry, it also increased costs for companies sourcing materials internationally. If he renegotiates more trade deals, we could see further disruptions across sectors like the automotive and electronics industry, which depend on intricate global supply chains to thrive. Part 3, long-term impact, the lasting effect on the global economy and markets. Looking into the longer term, Trump's policies could reshape the US economic landscape in profound ways. His tax cuts and spending policies are likely to contribute to increasing national debt, a factor that could weigh on future economic stability for the US. Whilst his previous term's policies were credited with a short-term market boost, they also contributed to rising income inequality and widened the federal deficit. With this in mind, let's consider the possible long-term implications if Trump continues his tax cut agenda. If corporation taxes remain low, it might encourage more companies to reinvest in their businesses, potentially driving up innovation and growth within the US. However, a mounting national debt could lead to inflationary pressures, which would erode consumer purchasing power over time. This could ultimately slow down consumer-driven sectors like retail and housing, as higher interest rates might be needed to curb inflation, something that we've seen recently over the last few years. Another aspect to consider is the long-term effect on the US and international relations. Trump's America's First policy might lead to a stronger dollar in the short term due to foreign capital inflows. However, a strong dollar can negatively impact US exports, making American goods more expensive abroad. This would ultimately hurt US manufacturers and could lead to a trade imbalance over time, resulting in a weaker dollar in the long run. Moreover, if Trump does alienate allies or disrupt alliances, we could see decreased confidence in US financial markets from foreign investors. In his first term, the Trump administration's stance led to tensions with traditional allies in Europe and Asia. Long term, this could reduce the appeal of US bonds, potentially driving up yields and making borrowing more expensive for the government and corporations alike. Part 4, how to invest during times of political shifts. So, when political waves shake the stock market, the knee-jerk reaction for many is to pull their money out of the stock market, hold cash and wait for stability. But history shows us that volatility, especially around major elections or economic policy shifts, can present unique investment opportunities. Trump's return to office has reignited these questions for many. Should you be cautious or should you lean into these changes? Personally, my view is the latter. However, you need to decide your own investment thesis and strategy, as I'm not a financial advisor and I do not provide financial advice. However, here are some key principles to guide your investment strategy during uncertain political times. Number 1 is to focus on defensive sectors. In periods of uncertainty, defensive sectors such as consumer staples, healthcare, and utilities tend to be safer bets. These industries produce goods and services that remain in demand regardless of the economic fluctuation. During Trump's first term, even as certain sectors wavered, consumer staples and healthcare showed resilience. With renewed expectation of deregulation and pro-business policies, healthcare could particularly benefit this time around, especially in the pharmaceutical and biotech segments where Trump has historically pushed for more innovation-friendly regulations. Likewise, utilities offer stability with their steady cash flows, often distributing dividends to shareholders, which can act as a cushion against broader market dips. For investors seeking lower risk opportunities, these sectors can provide both stability and income for you. Number 2 is to keep an eye on infrastructure and energy. If Trump follows through on his campaign promises to boost domestic energy production and modernize American infrastructure, these areas may see significant growth. Infrastructure stocks, which include companies involved in construction, engineering, and raw materials, could become valuable holdings, as Trump has already hinted at a renewed focus on American projects. In his first term, energy stocks surged due to deregulation efforts and similar trends could emerge. However, remember that energy stocks, particularly in oil and gas, can be sensitive to global oil prices and geopolitical tensions. Balancing investments in traditional and renewable energy could be a great way to capture potential gains whilst hedging against longer-term shifts towards green energy. Number 3 is to diversify with international and emerging market exposure. Trump's re-election is likely to increase volatility within US markets, especially as trade policies take shape. If new trade tariffs or trade barriers are introduced, it could strain certain industries and drive up inflation. By diversifying your portfolio to include international stocks, especially in emerging markets that stand to benefit from less dependence on the US, you could reduce your risk exposure to American-centric market shock. During Trump's previous term, emerging markets in Asia and South America often saw gains when US-centric risks materialized. For this reason, it's worth considering ETFs that track indexes in these regions, which will provide you with diversification without the need to buy individual international stocks. However, do be mindful of currency risk fluctuations in emerging market economies, which can add another layer of volatility. Number 4 is to embrace dollar cost averaging to reduce your risk. So, one of the simplest yet most effective ways of navigating a volatile market is through dollar cost averaging. This investment strategy involves investing a fixed amount of money at regular intervals, regardless of the market's current state. By investing a set amount consistently, say weekly, monthly, or quarterly, you automatically buy more shares when the price is low and fewer shares when the price is high, effectively lowering your average cost per share over time. Dollar cost averaging is particularly helpful during periods of heightened uncertainty, like the beginning of Trump's second term. In the past, significant political events have triggered short-term market volatility, causing many investors to pull out, only to miss out on the potential gains. With dollar cost averaging, you do eliminate the need to time the market, and investors focus on a disciplined approach that capitalizes on the natural ebbs and flows of the stock prices. So in practice, let's say you invest $500 every month in the S&P 500 index fund. If the market drops one month, your $500 buys more shares at a lower price. When the market rises, those shares previously purchased gain value. Over time, this averaging effect can reduce the impact of short-term price swings, allowing you to accumulate wealth steadily even when the market is unpredictable. Number 5 is to remember the power of staying invested and those two magic items, compound interest and long-term gains. One of the most valuable concepts in investing, especially during volatile times, is compound interest. This is a principle by which your earnings generate more earnings over time, accelerating the growth of your investment. For this reason, Albert Einstein allegedly called it compound interest the 8th wonder of the world, and for good reason. It rewards those who stay in the market consistently, even when times are tough. As you may recall, when Trump first took office in 2016, there was a mix of optimism and fear. Many investors who reacted emotionally by selling off stocks during periods of turbulence missed out on a prolonged bull market that followed, which saw the S&P 500 gain over 50% by the end of his term, yes, in 4 simple years. To illustrate how powerful compound interest is, let me share this example with you. If you invest $10,000 now, with a 7% annual return, which in honesty is a conservative estimate based on the long-term historical growth of stock markets, your investment could grow to around $81,000 in the next 30 years. If you invest more regularly, your gains compound even faster. The key is staying invested regardless of short-term political economic shifts to allow that compound interest to work its magic. It is natural for most people to want to time the market during times of uncertainty, trying to sell high and buy low. However, research consistently shows us that timing the market is not only incredibly challenged, but often leads to lower returns. Missing just a handful of the market's best performing days can drastically impact your long-term gains. According to a report by JP Morgan, if an investor just missed the 10 best days in the stock market over a 20-year period, their total returns would have been cut nearly in half. By staying invested and by regularly contributing even just a small amount through dollar cost averaging, you position yourself to benefit from both market recoveries and the long-term growth that compound interest provides. Markets may fluctuate in the short term, but over the long term, they tend to rise. Maintaining this perspective is essential for those looking to build wealth, even when the political landscape is uncertain. And to this point, I've been dollar cost averaging £25 a week into the S&P 500 since April, and I'm already up 12%, which is incredible. Number 5 is to build up your cash position. In uncertain times, having a strong cash position is invaluable. Cash gives you the flexibility to react quickly to market dips or new opportunities without needing to sell off existing investments at potentially unfavorable prices. As Warren Buffett famously advises, cash is like oxygen. It's essential when the market drops, giving you the ability to buy high quality stocks at low prices. Maintaining a cash position around 10 to 20% can provide the flexibility needed to capitalize on volatility without overcommitting your portfolio to high-risk moves. This approach also helps to mitigate psychological temptations to panic sell, as you have the liquidity available to take advantage of market lows. And finally, number 6 is to consider safe haven assets like gold and bonds. With treasury yields expected to rise and inflation concerns on the horizon, safe haven assets like gold and silver and treasury inflation protected securities are worth considering. Historically, gold prices surged during times of political and economic uncertainty, and given the potential for inflation and higher deficits under Trump's policies, it's reasonable to expect similar trends. We have already seen a large gold rally this year, and I personally expect this to continue. Invest in bonds, particularly short to medium-term government bonds, can also add stability to your portfolio. With interest rates predicted to rise, shorter-term bonds are less sensitive to rate changes and provide more predictable returns. And whilst bonds and gold might not offer the same growth potential as stocks, they can serve as essential anchors in volatile markets. So finally, let's wrap it all up. Trump's re-election and the immediate market rally with record highs in the Dow, S&P 500 and Nasdaq reflect a renewed sense of optimism amongst investors. His promise of tax cuts and deregulation have spurred confidence in specific sectors, but these also come with potential challenges like rising deficits and inflation risks. For investors, navigating these shifts require a blend of strategy, discipline and long-term thinking. In volatile and political environments, there's no substitute for a disciplined, well-diversified approach, and this is something I tell many of my friends every day. Many of them have only just started investing this week as a result of their optimism for the market. By focusing on time-tested strategies like dollar cost averaging, maintaining a long-term perspective, and leveraging the power of compound interest, you can weather the market fluctuations whilst building your wealth steadily. Thank you for joining the deep dive into the market impact of Trump's re-election. If you also want to understand some other risks in the global markets right now, watch this video here discussing commercial and Chinese real estate. If you found these insights valuable, please don't forget to like and subscribe for more detailed financial analysis.